Hello everyone, welcome back to the channel. So today in this video, I will try to connect the dots that can sound simple, but it is not so obvious. Our news channels also do not report it in a way that we small investors can make more sense of it. And when I say that, I do not mean to be harsh, but I say so because the news covers these topics in pieces. One day they talk about tariffs, another day it will be about the Russia-Ukraine situation, another day it will be about FIIs selling the market, and then they will talk about the US-Iran war. And finally, it is on us to make sense of all these disconnected stories. What I want to do in this video is to connect all those pieces. So next time when a similar news flow is reported, we will know how to make sense of it and how to connect these news events with our investments. After this video, I think you will see a clearer picture of what is happening in our markets and more importantly, how it is affecting our investment portfolios. So let's begin. I will start with the impact Russian oil had on our investments. Let's go back to early 2022 when Russia invaded Ukraine. After that event, the United States and Europe imposed very heavy economic sanctions on Russia. One of the most significant sanctions was on Russian energy. US and Europe refused to buy the Russian oil. Now, Russia is one of the largest oil producers in the world, and suddenly a huge portion of its buyers had walked away. So Russia was sitting on a lot of oil and had very few buyers left. In such a situation of supply-demand imbalance, the price drops steeply. Hence, Russia had to offer very steep discounts to whoever was willing to buy their oil. This is where India stepped in. India started buying Russian crude oil at a discount of sometimes even $10 to $15 per barrel compared to international prices. Now, to understand what that means for India, let's take an example. Suppose you are one petrol pump owner. Only you have access to Russian oil and not the other petrol pump around your area. Hence, you are able to buy petrol at rupees 80 per liter when everyone else is paying rupees 90 per liter. What happens to your profitability? Comparatively, you are going to make much more money on every liter of petrol and diesel you sell, right? This is exactly what happened with our public sector oil refineries. Companies like BPCL, HPCL and Indian Oil Corporation made good money due to the cheap Russian oil imports. Remember, during these times, the international oil prices were soaring and this also contributed to the bottom line of our refineries. Let's see how. These PSUs were purchasing crude oil at a lower cost from Russia. Then they were refining it to produce refined products like petrol, diesel and jet fuel. And then they were able to sell these products at a prevailing price in the international market, which was already very high. So as a result, their profitability margins improved. And if you were holding stocks of these companies during that period, your stocks saw huge gains. Between October 2023 and September 2024, HPCL and IOCL stocks rose by almost 2.75 times, 175% gains in a matter of just 10 to 11 months. During that period, India's import of Russian oil went up from almost nothing before 2022 to over 35% of our total oil imports in 2024. At that time, India was one of the Russia's largest oil customers. Europe and America was not happy with this trade and they were saying that India was actually helping Russia in the war. But I think India was not helping any war, we were helping ourselves. A country which imports 85% of its crude oil demand, India was not in a position to pay more for oil just to make a political statement. We have inflation to manage, we have a current account deficit to control, and we also have crores of people whose cost of living depends on energy prices staying low. So I think Russian oil purchase made economic sense for us at that time. Moreover, Indian equity investors benefited as our refineries made good money due to cheap oil imports. It was not only good news, Russian oil imports also had serious repercussions on India, and let's discuss that as well. Now, this arrangement between Russia and India was always going to attract some reaction from the United States. And that reaction came gradually in the form of tariffs when Donald Trump became the president in 2025. And at that time, Donald Trump was trying to act like a negotiator between Russia and Ukraine. At that time, he found that Russia was not so inclined about the ceasefire as China and India were already buying most of the oil produced by Russia. Irrespective of the trade sanctions by the US and Europe, Russia was able to sell its oil. So, to kind of punish Russia and discourage India to buy Russian oil, Donald Trump imposed huge trade tariffs on India. Let's understand quickly what are tariffs, as it is necessary to know this, how all of this eventually started affecting our stock portfolio in India. A tariff is simply a tax that one country puts on goods coming in from another country. If India exports, say, pharma drugs to the US and the US puts a 20% tariff on that, then the importer in America has to pay 20% extra price to get those drugs inside United States. This makes Indian goods more expensive in American market. It means Indian exporters would either have to lower their prices and as a result suffer in the margins, or they may risk losing the business altogether to competitors from other countries. Now, coming back to what Trump did with India in terms of tariffs. The Trump administration imposed high tariffs of 25%, calling it reciprocal tariff on India. On top of that, there was an additional tariff of 25% specifically linked to India's purchase of Russian oil. Putting these two together, for India, the tariff went up to 50% on a wide range of Indian goods. This directly hurts the business and profits of Indian companies in sectors like textile, gems and jewelries, chemicals and manufactured goods. So what was the effect of these high tariff on the stock market as a whole? FIIs started pulling out money out of the Indian stocks. In 2025, Indian market saw some of the largest FII outflow in recent history. And when FIIs sell, they sell all Indian stocks no matter in which sector they belong. This is the reason why we saw deep corrections even in stocks like HDFC Bank, ICICI Bank, Britannia, Nestle, RIL and all IT stocks. When FIIs sell, small investors like us may feel that they are selling because valuations are expensive or global uncertainty is very high. And yes, those things are true to some extent. But at that time in 2025 when FIIs were selling, there was a deeper layer of complexity, and that complexity was related to the tariffs. But unfortunately, as the tariff situation got resolved in 2026, US-Israel war started and made the situation even worse for Indian stocks. As a result, our portfolio, which was already weak, went into deeper red. Let's also understand the details of how the US-India trade deal was a step to resolve the tariff situation and would have benefited Indian stock investors, but it did not materialize due to the start of the Iran war just after the deal was closed. Nevertheless, just for academic purposes, let's understand the possible impact of the deal on our Indian stocks. Now in early 2026, India and the United States reached a trade agreement. The reciprocal tariff on Indian goods were reduced to 18% from 25%. The additional punitive tariff of 25% that was specifically linked to India's Russian oil purchase was removed entirely. What India gave to US in the deal? India committed to stop purchasing Russian oil. And India also committed to buying $500 billion worth of American goods over 5 years. Just for perspective, India imported about $130 billion worth of crude oil in FY24. So we can say that $500 billion is a very large import number for India. And what India could import from the US? It could include things like military equipments, energy, particularly LNG and technology products. So let us think about what this means for India as a trade partner. India gave up something, and that was the cheap Russian oil. India also got something in return, and that was the lower tariffs on its exports to the United States, which helps a lot of our export dependent Indian companies. We must also remember that the EU free trade agreement also came through around the same time, opening up a large market for India. Now I want to say few things here. I will not say whether these two deals were good or bad for India in a political sense. This is a very complex situation and reasonable people can disagree on it. What I am going to tell you is what this deal means in terms of sectors and companies. Because for us as investors, what's matter more is the awareness of how these deals and other factors are influencing our stock portfolio. But before we go into the sector specifics and stock specific, I want to mention one more thing that happened in the market during the same period. I want to pick this point here because it directly affects our stock portfolio. I want to talk about a kind of new battle between FIIs and domestic investors now being played in the Indian stock market. So while all this geopolitical drama was going on, foreign investors, FIIs, were selling heavily in Indian markets. But something remarkable was also happening. The market was not collapsing as it did in 2008 or in 2020. And the reason for that is the domestic investors' money coming into the market through DIIs. Who are DIIs? They are our mutual funds, our insurance companies like LIC, and our pension funds like EPFO. These institutions were buying consistently even as foreign investors were selling. On some of the worst days of FII selling, DII buying was absorbing most of that pressure. Now, where does DI money come from? A significant portion comes from our SIPs. Every month, millions of households put in their 2,000, 5,000, 10,000 rupees through SIPs into mutual funds, and those mutual funds deploy that money into the stock market. So it means the retail investors in India, people like me and you, provide the market with the stability during a period when FIIs were leaving the Indian market. I think this is an important point to understand. It is not just a feel-good point, it tells us something about the structural maturity of the Indian stock market. A few years ago, when FIIs sold heavily, our markets would fall very sharply and would take a long time to recover. That pattern has now changed. The domestic investors base has become so large that it has emerged as a meaningful counterforce to the FIIs' mood swings. This is actually a positive development for the long-term health of Indian equity markets. The thing is that when the market was falling due to FII selling, SIP money kept coming in, and as a result, it prevented the market from crashing. So for investors like us, the point is that as our stock market is getting almost equal support from domestic investors, the downside risk of market crashing every time the FIIs exit is much lower now. Hence, for long-term investors, the Indian stock market is becoming more dependable. Now let's understand how the recent geopolitical events have affected our Indian stocks and which sectors stocks were most affected. So now let's understand how these world events are affecting our stock portfolio. We will see where the opportunities are and where the risks are. Let's start with the pharma sector. The Indian pharmaceutical sector was largely exempt from the heavy tariffs that the US imposed. The US healthcare system is deeply dependent on Indian generic medicines. American patients rely on affordable Indian generics from everything from blood pressure medication to antibiotics. The US cannot afford to make these medicines expensive by adding tariffs because that would hurt American consumers directly. So pharma companies like Sun Pharma, Cipla, Dr. Reddy Labs were relatively insulated from the tariff pressure. And now with the EU free trade agreement in place, there is a significant new export runway opening up for Indian pharma companies in Europe as well. The EU is also a large, mature, well-regulated market like US. It is not easy to enter the market, but once you are in, the cash flows and margins could be as stable as it is from the US. Indian companies that have The quality certifications and the regulatory approvals to sell in Europe stand to benefit meaningfully over the next several years. Hence, quality pharma names with growing export exposures are worth looking for a long-term holding. Next is textile, gems and jewelries. These are export dependent sectors. India's tariff on exports to the US has come down from 50% to 18%. But we need to compare that to our competitors. China faces a tariff of 27% on many categories. Vietnam, which has been a major beneficiary, faces a tariff of around 16%. Bangladesh is also having its own complications with a tariff of around 20%. So relatively you can see, as compared to these competitors, India with 18% tariff is still competitively placed in the US market. Companies in textile, particularly large, better run ones with established American clients, could get more orders shifting towards India. Gems and jewelry is in a similar situation. India is the world's largest cutting and polishing center for diamonds, and our jewelry export industry is significant. A stable tariff environment with the US will help these companies plan better and retain their American clients. The defense sector will also benefit. How? India's defense sector is interesting from an investment point of view now, and the role of geopolitics is playing a key role in the growth of this sector. There are two factors playing in favor of this sector. First, one of the unstated but very clear implication of a closer India-US relationship is that India will be expected to move more towards American defense platforms and equipments. Second is India has its own stated goal of self-reliance, especially in defense manufacturing. Indian government wants to indigenize defense production. These two things are actually working together rather than against each other to boost this sector. How? The pressure to move away from Russian military equipments, which India has relied on historically, means India needs to fill that gap either by buying from the US or by building it domestically. Both outcomes are good for Indian defense companies like HAL, BEL, Cochin Shipyards, Musgaon Dock, etc. This is a long cycle story. Defense procurement and manufacturing takes years. Hence, for long-term investors, investing in defense stocks for a period like 7 to 10 years could be quite beneficial. But we must be very closely observing the valuation of these stocks as they are trading at a very high PE multiples. Indian IT services sector, companies like TCS, Infosys, Wipro, HCL Tech, etc., already has very deep relationship with American corporate clients. A more cooperative India-US relationship generally means more comfort for American companies to deepen their technology sourcing from India. The $500 billion commitment that India made to buy American goods will likely include significant technology components, and some of that will flow through to Indian IT firms that manage those systems. But this is also true that IT is not a dramatic story like defense and pharma. It is more of a steady, supportive theme. I think this sector fortunes depend more on global IT spending cycles than on geopolitics. But the political relationship between India and the US provides a floor of comfort to these IT companies, and that is very important. Let's talk about PSU refineries. I want to say this to those investors who are holding stocks like BPCL, HPCL and Indian Oil. If you are holding these stocks expecting the same tailwinds that existed between 2022 and 2024, those tailwinds are now gone. The Russian crude discount was big bonus for these companies. That bonus is now credited and already spent. When India has stopped buying the discounted Russian oil, that benefit was lost. Now, even if India resumes the Russian oil purchase, it will not be the same discounted oil. Apart from Russia, India will now have to source oil from their previous oil suppliers like Middle East, from the US, potentially also from Africa at the present market prices, not at discount. The raw material cost of these PSU refineries will go up. For sure, their refining margins, which had been inflated by the cheap input, will now normalize. This does not mean that these companies are bad businesses. They are large, vertically integrated, and strategically important to India. But the era of unusual fat margins for these companies that we saw in the recent past is likely behind us. If you are holding these stocks, you need to reassess your logic of why you should hold these stocks now. The reason that you had back in 2022 and 2024 are no longer valid. They may not even continue to yield the same level of dividends that they have paid in last 2-3 years. So you must think twice if you want to invest in such companies, and if you are already an investor, whether you should continue holding them or not. Finally, I want to talk about the agriculture sector. This sector is politically the most sensitive and therefore most uncertain from an investment standpoint. One of the long-standing demands from the US side in trade negotiations with India is access to the Indian agricultural market. They want the following: lower tariffs on American farm products and relaxation of restrictions on certain crops and seeds. India has always been very cautious about this, and for good reasons. Agriculture employs a large portion of our population. Allowing cheap, highly subsidized American agriculture products in large quantities could hurt Indian farmers significantly. This is not just an economic issue, it is a political issue of the highest order. So companies in the Indian agricultural input space, like for pesticides, seeds, for agrochemicals, would face some policy uncertainty. I'm not saying to avoid this sector entirely, but it is a space where you need to be aware that the regulatory and the policy environment could change, and not necessarily in a direction that it would benefit the company and the investors. So allow me now to conclude this video. What we are seeing is that geopolitics and stock markets are becoming much more interrelated than they used to be before. 15 years ago, we could largely ignore global political events when building an Indian equity portfolio. That is no longer true. The Indian US tariff situation directly affected FII flows. FII flows directly affected index levels. Index levels affected the sentiments of retail investors, and the retail investors' behavior of staying invested versus panicking versus selling affected whether the market stabilized or not. So as an investor, we need to develop a habit of reading the geopolitical picture alongside the financial results of companies. So, what we should do in such an unpredictable environment? First of all, you should stay with quality companies, stay disciplined with your SIP, and we must also understand the world in which our companies, our stocks are operating in. Thank you for watching.